Thanks for tuning into Talking Point today. I'm your host, Niraj Shah. The case for a chat, and right up on your screens here, are FI outflows a fleeting concern or not really so? Can Q2 results aid valuations by proving to be a good quarter, or will it on expected lines be a bit of a dampener? Are new age companies the best way to play consumption if you want to play consumption in the first place? And that's a micro point, but the macro point is the legitimate pieces of concerns that we probably have around markets currently. Are they indeed that legitimate? The best person to answer all of that in his own style, Mr. Samir Arora of Helios Capital. Samir, so good having you. Thanks for taking the time out.
Good morning.
Samir, just trying to understand, is this a legitimate concern that the markets have had in the recent past, this whole allocation to China? Because we're seeing inflows into China, outflows out of markets like India. Is this a fleeting thing, or can this last?
I think this is a fleeting thing. The many things can be there on valuation and others which may take longer. If some people believe that, we can discuss that also. But on China, my point generally is that many people were extremely underweight, and many people were, on the other hand, extremely frustrated. And these were the large investors who had in interviews or in the newspapers, foreign newspapers, you could read them talking openly about what their views were on China, that, and these pension funds and endowments and others who I don't think can change at a dime, on a dime. So therefore, I think that the large guys will not easily be moving from one market to the other, because just understand the structure of the emerging markets benchmark or the index. So there are maybe less than 47% combined India plus China. And there is 50, that means 52, 53% in markets like Taiwan, Korea, etc. So if somebody wants to now invest in China with a fixed amount of money, there are many other places from which logically you can move to China if you so want. Because these are two different trades. One is supposedly a secular long-term trade where most of the things are working all right. And the other is more, okay, it went to extreme value and is already up 30%. So by switching from here to there, what extra value add will you do in a short period of time? But in a short period of time, some hedge funds, some people who were caught on extreme underweight or short in China may be doing it. So I think it's a fleeting trade. It doesn't change the long-term attraction, maybe of both. But I don't think one is at the cost of the other. In fact, India is in absolute terms, maybe not in relative terms, better off if China and all do somewhat well. Because one criticism of India was that our Indian market valuation premiums to emerging markets have gone up a lot, to Asia, ex-Japan valuations. And a large part of that was triggered by the fact that China was doing very badly. And second thing is, if all other markets are doing well, that is US is clearly doing well and China also is doing well, then there is less reluctance on the part of the Indian mutual fund manager sitting on cash. Because if the world is up, we are unlikely to be down. We may be less up.
Okay, yeah, that's a telling point too. Just wondering, Samir, though, I mean, the part two of the question was this, that at the end of June quarter, FI ownership in India was what, 17% 12-year lows, what have you. There were some inflow, right, somewhere around that. And then there were some inflows, never mind the outflows that have happened last week. It's not that FIs are really overweight India as well, right? So therefore...
Absolutely. If you look at the MSCI index, I think they might be plus minus, they may be plus 1 or 2, 1%. That is, India's weight at the end of August, I think, had become 20 point something or 21, which was supposedly just crossing China at that time. And then with the sharp rally in China, their index rate must have gone back to whatever, some 24, 23, 4%. But even prior to that, it was not that India people were so overweight that trade will be played, which is sell India to buy China. And that also after a 30% difference between the two markets in, say, a month.
Got it. So therefore, the 45 odd thousand crores of outflows that we've seen, let's say, right, in the last week odd, if you will, skeptics would say this doesn't change easily. I heard you say that this might be a fleeting concern. You reckon the pace of outflows over the next 2-3 weeks will moderate?
It will moderate, but first of all, the timing of that the pullout was also at sort of the same day, on the day when SEBI was supposed to come out with the rules on F&O, and this happened prior to that. I think that day, when in the evening the thing was, that day also they took out a big amount. So who knows what was the exact reason for taking out? But I can't big picture imagine that this pace can continue. And I think the pace, by the way, wasn't Friday lower than Thursday anyway by 2-3 thousand crores. So I think it will decline with time.
Got it. Geopolitics has only increased, Samir. I would love to know. For the longest time, we said Russia, Ukraine, now it's going, the world has learned to live with it. Then something else, now a heightened Israel-Iran issue as well. Is that a concern in your mind for markets?
So it may be a concern, but why should it be a concern only for Indians or Indian market? So I am only driven by the fact that gold is not up a lot, that oil is actually not up a lot. I mean, it was down so much that if it goes up 6-8% is part of life. And the stock markets are not down anywhere. So, I mean, they are not down, or maybe they are up actually. In US, it's up month to date. And of course, China is up. So why are we taking it as if it is our sort of duty to reflect that? Although big picture, you can say it's a concern if things go out of control, but why only for the Indian market? So one reason could be that India has generally done well. But as of now, year to date, India has not done anything great, at least at the index level. Or if I look at the Nifty, it is up 15% in rupee terms, and the year is like 2-3 months, so you can annualize it and make it 18%. And generally, our longer term returns of index would have been, say, 14%, 14 and a half, 15%. So it's up 3% more than what it should be. What's the big deal in that? Even if you look at 3-year numbers, even if you look at 5-6 year numbers, the real story is that the small caps and a part of the mid caps have done very well, and it's that which is responsible for us all feeling that the market is rocking beyond limits. Just to give you some perspective, in the calendar years 2004, 5, 6, and 7, for 4 consecutive years, the annualized returns of the NSE index or NSE 500 index or whatever was some 45% per annum for 4 years. That is called a bull run. Here, a small part of small and mid cap stocks going up is a good bull run, but it is not, I don't think it is some wild thing that is happening.
Okay. So is Samir Arora constructive on Indian equities from where we are right now?
Yes. We are constructive because my thing is, number one is that it is very difficult to preempt these global issues. So if somebody says, oh, what happens if tomorrow Iran comes in, or these Israel guys go and again attack Iran, or something happens, then we have to react. But preempting these global issues, for example, oh, China is very aggressive with Taiwan, let's say, not today, but I think in general. What am I supposed to do about it? Because they may be only talking, saber rattling, never do anything, these things. For example, if on 21st February, or whatever the date was of 2022, you had said that Russia will be fighting with Ukraine, you would have, no, these things don't happen normally. There is this, there is NATO, there is UN, there is, you blacklist these guys, you sanction them, nothing happens. So these things are very difficult to say. And even there, when I actually got negative and raised 20% cash for 2 reasons in 2022. First reason was my correct view that the interest rates will be hiked a lot. For whatever reason, I can remind you, I said it even in Jan, Feb of that time, and they were raised a lot. And then the war happened, and we raised 20% cash, and the market did not fall, I think, even a percent after that. Maybe it went up 3-5% for the rest of the year. So this raising of cash is a very difficult thing, which is the end result of whatever this analysis we are doing. And today I feel that if US market is very good and the Chinese market is very good, we may underperform for some time, do this, that, but we are not really falling to make my normal stance and my normal actions very, negative.
Okay. One of the things that came out in conversations, I was out for a few days, and people cited that the state election exit polls are also turning out to be a bit of a concern. To your mind as well, is that a concern? I mean, we don't know what the actual result will be, but
Yeah. But assume that BJP is losing Haryana, I think maybe that one was known. It might be a little bit more when if they lose Maharashtra. But generally, after the elections, the the day-to-day thought or thinking that what the government is doing and what policies they are doing and what changes they're bringing has come down. Now, that is good or bad. It could be considered good in the sense that the market is no longer depending only on government announcements and steps, because many of them were announcements and they take so long to convert to reality on the ground and earnings for corporates. But that is true actually since the budget, and that's why there's been a change of somewhat leadership where the PSUs and defense and railway guys are not doing that well as they were. And that I've been saying since the budget day that that has changed, yes.
Okay. Okay. So, Samir, I'm just trying to understand, because you got this great global experience, right? If you were this large fund, and I heard you say that those large endowment funds don't change in a hurry, but China valuations attractive, they are giving stimulus, so on and so forth. India, expensive valuations on a relative basis, and geopolitics, etc. So if you had a choice of allocating fresh money or reallocating, would you actually do large changes if you had the choice to?
So that's what I'm saying. Even by the way, we have a global fund.
Exactly, which is why I asked you. Yes.
In January, we had bought 2 stocks after 1 or 2 years of China, Alibaba and C-Trip. And then last week also we bought Alibaba. Okay, I'm not the main fund manager there, but I'm sort of part of the gang. So the thing is that the reality is that it is cheap.
Yes.
And if it is turning, it can go up. But let's talk now from a point of a fund manager who is invested in India. And he's unlike this global fund where we bought how much, like total 4-5% combined. But if you're looking at a fund, emerging market fund, or other guys or people who have given money to separate accounts and things like that, and there is, in theory, India plus China plus 53% in other emerging markets, plus you've done well in Japan. So all that money, and plus most of these funds keep getting some new money, plus the trade difference between India and China is already in 1 month some 30-35%. So how many people, how much money do you think will go on that basis, where separately India as a secular story is well accepted, was well accepted? See, it's also an issue of embarrassment. If you got to the board and said that we are stuck in China because of being stuck in private equity, as they've said in many interviews, they said to us face to face in many meetings we had in January, February of this year, saying that there is no payout by the PE funds and therefore we are not able to invest in India, and that China, we are down so much. And suddenly for them to go back, the people who are of that kind, where they go to boards, where they have investment committees, where they have political issues of investing here or there, whereas there is a separate crowd of hedge fund guys and small funds who may be underweight in China, and even with a 30% move, just like Indian or even global fund managers come to India and buy these IPOs post-listing when they are up 40-50%. And you can see in these 2 recent IPOs where people bought them after a heavy pop on day one and the stocks are down 20-25%. Broadly, some of them will have the same experience there. But even if not, and even if this continues, this is a shorter term trend, plus minus 15, 20, 30 days, I think less than that. This part, that if any money is actively being taken out of India to put into China, that trade is not longer than this, I think. But normally they will do well, and people may allocate more new money to it and they may outperform India for some time. That is possible. It's like value stocks outperform growth stocks for some time, for 2 years, and then that's possible. But I'm saying it's unlikely that we'll be negative.
Got it.
If every other market is positive, and that is the first point.
No, I find it interesting that the narrative in the last 7-8 days has moved so much to the FI outflows, wherein the narrative for the previous 9 months was mutual funds are sitting on 1.5 lakh crores of cash. So, dips will be bought into. So you reckon this is a dip that is waiting to be bought into?
Well, it is being bought in the sense that if you see every day the mutual fund and FI flows match each other, because that is also reality.
That's
if they're selling, who's buying? Somebody has to
True.
I think the other thing is that, let's say that Indian market was some 20, people used to say it's 15 odd percent overvalued compared to its longer term history. That means P of India and P of, say, emerging markets or Asia, but mostly emerging markets, say 15, 18, 20%. Now, with the Chinese market having gone up, say 30%, and its weight in the index about 20 odd percent, that means it has itself pulled up the whole valuation by 5, 6%. Therefore, you are now say 10, 12% overvalued, or not overvalued, higher than what the longer term average is.
Right.
It doesn't have to be that you have to get to longer term average, but it is within ballpark. You're not going to be paranoid if you are saying that we are 10, 12% higher than our longer term average, because then on the other side, we will give you 15 reasons why India is doing well. It's become a large market. There was still a China plus one trade. Our fiscal deficit situation is better than many countries. Our current account deficit is sort of 1% type, so our currency may depreciate less, blah, blah, blah. We are the fourth largest market. So when we go up a little bit, also the world cannot ignore us.
Right.
You could have said, okay, we are the great market, but you are like a small cap stock, which it doesn't bother me. So you can say 5% is because of these reasons, or domestic flows, which has reduced volatility of the market. And you reduce volatility of the market, that itself, in theory, should reduce your cost of capital and increase valuation, blah, blah, blah. So therefore, big picture, plus minus a few percent here or there, you are like you were before, which means reasonably valued for reasonable returns.
Reasonably valued for reasonable returns. Perfect. So Samir Arora, if you were putting in money to work, would you, by nature of the first answer that you gave me, be inclined to put it more in the larger pockets versus the mid-size, small-size ones?
In general, yes.
In general.
But what happens is the analysts in our firm and in every firm come up with these ideas saying my mid cap is very good because it is doing this and that. So since being bottom up, the large caps you buy only saying, okay, they haven't gone up. But there is no real bottom up excitement in them. And therefore, it has to be a combination. And even when we keep saying that large caps will outperform, in the end, we do at the same time talking and buying mid and even small, because that is more bottom-up fun. But yeah, in a big picture sense, it is large cap. Actually, by the way, although it was not intended to be that, but Helios is just launching a large and mid cap mutual fund in India in a few days.
Okay. So but you're saying it's not intended for that, but the theory would have been.
I'm saying I didn't plan it with you, and you didn't even know in case the public that this was leading up to this great question.
Okay.
I am not into all that.
Yeah.
We can do well without all these things. But I'm saying in general, yes, even we felt as a firm that large. And what I'm saying is, but in a flexi cap fund or in my offshore fund, it's not that I've absolutely stopped buying a mid and small, because in a big picture sense, I feel that mid and small have done very well, because you feel more excitement and more discovery kind of thing in something similar in that sense. So it's both.
Okay. Samir, you mentioned that 45% CAGR performance for the NSE 500 2004 to 2007, and saying that that's the real bull market.
That's a bull market.
So am I to assume that you believe that this is still an ongoing version of a bull market, if you will?
Let's do numbers only. So just to give you what is a bull market. So right now, if you look at the last 5-year returns of the NSE 50, Nifty.
Yeah.
So Nifty, I think, will be some 17, 18% per annum. Okay. Depends on which day you start and you drop off some day there. And the market, if you do longer term, will be some 14, 15. Depending again on which period you consider long term. So you are some 3% more per annum for 5 years. So that's a cumulative outperformance, let's say, of 18, 20%, 17%, 15%, right? And now that 15%, if you're overvalued as compared to a longer term average, how many things will you change for that? Because it is not wild beyond limits. Just to give you a perspective of what is a bull market and what is a mad bull market, in the year 1999, the NAV of my fund which was the Alliance Equity Fund, in the calendar year 1999 went up 280%. And our balance fund, which is now both these are Birla funds, the balance fund, which was Alliance 95, now called Birla Sun Life 95, the NAV was up 170% for a
Okay.
mutual fund. That is what I call a bull run. And then in 4 to 7,
Huh.
the annualized return of the market was 45% per annum.
Right.
And my hedge fund went up plus minus that, which is only 60 net. So
Sure.
that is a bull run. Here, the bull run is limited to a few stocks. And those stocks, if you don't buy or you buy less of. So recently, Kotak put out a report, and Kotak is negative, as you know, on
Yeah, yeah.
caps and all. Sanjeev Prasad must have been the author, I think, that they looked at the mid cap 150 stocks. But they did only for 1 year, I think. And they say that 25 of the 150 stocks were responsible for more than 50% of the index moves. And some 30 odd stocks were below 10%.
Right.
So it is. Large caps haven't done great because we know the banks haven't done great, the IT hasn't done great, the traditional consumer hasn't done great.
Right.
But some other things have done well, like these oil and gas and PSUs and others. So therefore, maybe that index is okay. And then in the mid-cap index has done well. But again, there it's a bit concentrated according to at least for the last 1 year or whatever. So don't buy some of those. So our conclusion is don't do the obvious bad things. Rest you can continue to do what you want. And according to me, one obvious bad thing is not that don't buy IPOs. But don't buy an IPO after listing. That is height of ridiculousness, particularly when they are popping 30, 40, 50% on broadly very expensive IPO price to buy that. That is overdoing the madness.
Okay. So what is obvious non-silly things? I'm just trying to understand. So avoid, you gave us the avoid list. So maybe it's a defense, the
So
railways,
obvious
etc. Avoid.
non-silly things are financials.
But that's
Obvious-
large cap.
Yeah, that's large cap. And but you know, in financials at least, the rest of the financials, not only the banks, even others, at least they grow properly. They grow 15, 60%. Here we are buying that there is rain, so this fellow instead of growing 3% will grow 7% or something. That I don't like that, but that somebody may do or not do. But I saw your initial listing that what is the best way to buy consumer? Is it to buy the new age? Well, some of it we agree since we have now all the three new age companies, which is Paytm and Zomato and PB Fintech. Yeah.
And you think that growth story, never mind the valuations, is still intact and alive and kicking and will deliver returns?
That's what we think, that the growth is very good and here is a shortage of high growth and there is no real big competition. In the case of Paytm, which we own, let me again explain. The thing is that a second company cannot go public unless this guy does well. You know, all these other 25 fintechs can go dream of getting listed. This stock doesn't do well. And in a big picture sense, what happens is it's not that they start buying the stock to make it go well, but they change themselves and they try to make some money so that they can go public by saying we are not loss making or we are making very less loss. And therefore that helps the listed company. And you can see that literally happening. And me indirectly telegraphing it via Twitter in about 6-9 months ago that Swiggy cannot go public unless Zomato does well. And so what happened was Swiggy then introduced, or maybe they followed, but the platform fee came in and then Zomato did well. And when Zomato stock went up, Swiggy can say, hello, I'm coming at a discount to you. So these things happen in every sector where if the first guy has not done well, the second guy cannot go public, and if the second guy has no money and the first guy is public and has money, then sometime later the second, third, fourth guy have to start competing less and worry about their own profitability. And as soon as they worry about their profitability, the first guy also does well. This is my big picture thesis. But otherwise also, the growth rate in these things is better than our 5-7% growth that the staple guys do because rain is coming. I remember in the 90s, our office was in Burley and we would look out and the joke used to be that if you see rain, That's where the fund managers are sitting. Then you go and buy Hindustan levers. Those days, I think, are not. I don't want to do those.
Okay. Since we're talking IPOs, Samir, going public, etc., the talk of town will be the mega Hyundai IPO as well. I'm not asking for your view there, but it's the first auto IPO after a long time and no scarcity premium. And a lot of people compare the Hyundai valuations in Korea to Hyundai India's valuations. I mean, maybe partly faulty argument because everything in Korea is cheap. I'm just trying to understand, what do you think about autos per se, and therefore maybe an IPO in this space?
I have said it in a big picture sense. The number one most ridiculous trade in the world, not just in India, is auto. It is absolutely top down, so easy to prove that it is a wrong trade. How? So there are these auto companies, which I've said many times, so I feel like repeating myself. But you have these IC engine car manufacturers, and the system or the society or whatever, consumers or climate, this thing say, now you have to make EV cars instead if you want to basically be remaining in business. So all these guys spend billions of dollars to move to new technology, but there is no promise that therefore the market size will go up or that your profitability will go up. You are basically spending all this money to remain in business. That itself would have been a very big capital destroying activity. But in addition, what happened is that there were new competitors who had no plans of being in IC business. And suddenly, when the EV business started, they said, oh, this we also can do for whatever reason that they thought they had. And so from Tesla to BYD to Ola, all these guys who were not there in the original industry structure are new players. Again, has anybody ever said to you that because we are all moving to EV, that the market size is going up from what it was, say, before this happened, or that the profits will be higher? No. For the same industry, the number of players are more, and you are all having to invest. Now, the only thing we can say in India is, oh, we are protected. You tell me how much multiple will you give to a company which is making its money because of protection. And you know that every guy, not just the Korean guy, every guy in the world has warned about declining sales. Their stocks are down 20-30% this year, whose multiples are 4 to 5. But no, we are here. So in some things we also accept, but this is too blatant according to me on every angle.
Samir Arora, thank you so much. Trust you to call a spade always, but thanks for taking the time out. And festive greetings in advance, Samir. Hopefully we'll talk once around the Diwali season.
Okay, thank you very much.
Bye. And viewers, thanks for tuning in to this leg of Talking Point.